Medallion Financial Corp, ticker MFIN. They just delivered a Q2 2026 earnings beat on the bottom line, alongside a mix to slight miss on net revenue.
Right, they reported 31 cents per share, which, easily beat the consensus estimates of 27 to 28 cents.
But net revenue came in at $58.06 million, so they missed the $59.97 million consensus by roughly 3.2%.
Yeah, though adjusted revenue of $61.72 million did clear some analyst tracks.
True. And looking ahead, management reaffirmed their full-year 2026 loan growth targets right in that mid-teens percentage range.
Yep, they expect a seasonally strong Q3, followed by a bit of a moderation in originations in late Q3 and Q4.
With stable origination yields holding around, 14.75% for recreation?
Exactly, and 9.25% for home improvement. But the market's reaction to all this was just, it was a total roller coaster.
It really was. The stock popped in pre-market, closed the first regular trading session up nearly 2% at $10.12.
And then in the very next session, it just sharply reversed course. It dropped almost 2% to close at $9.94.
So I want you to consider this immediate disconnect. Why does an 8 to 14% EPS beat result in a day 2 stock slide? Let's walk through the segment details to uncover the drag on this quarter's numbers.
Well, the disconnect stems entirely from the upfront cost of that hypergrowth. When you look under the hood of this print, the volume they're pushing through their system is, frankly, staggering for a specialty finance company of this size.
Yeah. Total assets surpassed $3 billion for the first time in company history, right?
Right. They officially hit $3.194 billion. The total loan portfolio itself grew 12.5% year over year, but to $2.795 billion.
But the metric really driving the whole narrative of this quarter, and ultimately the stock's volatility, is their origination volume.
Oh, absolutely. Overall loan originations just exploded by 63% year over year. That's $611.6 million for the quarter.
Okay, so this looks like a classic V8 engine running on all cylinders scenario. But is there a risk they are pushing the RPMs too high?
How do you mean?
Well, growing originations by 63% in a tight rate environment just feels incredibly aggressive. I immediately want to know where that volume is coming from.
Fair point. So their biggest engine is recreation lending. That makes up 63% of their total loans.
Right.
The portfolio hit $1.76 billion, with originations jumping 63% year over year to $228.5 million. And they held yields strong at 15.06%.
See, I look at those numbers, and honestly, I see immense risk. The weighted average FICO score at origination was 686.
Right, which is...
a 686 FICO borrower financing a luxury item like an RV or a boat at 15% interest when inflation is squeezing household budgets. That feels aggressive.
Mm-hmm.
Tell me why I shouldn't panic about them chasing yield down the credit spectrum just to juice their top line.
Well, the panic usually sets in when you assume a recreation loan behaves like an unsecured personal loan, which, it doesn't.
Because it's collateralized.
Exactly. These are heavily collateralized assets. Medallion isn't just writing blank checks. They're financing tangible assets where the borrower has significant skin in the game, usually through a meaningful down payment.
Right, they have something to lose.
Right. Furthermore, a 686 FICO in the recreation space is actually considered prime to near prime. It represents a borrower who generally has a solid repayment history, but might just have high credit utilization.
Okay, so Medallion is pricing for that specific wristband.
Yes. They're generating a 15.006% yield because they understand the historical loss severity on, say, a repossessed towable RV versus a speedboat. They have decades of data modeling exactly how this demographic behaves during economic tightening.
So they're taking on calculated collateralized risk on the recreation side. But consumer discretionary spending is still usually the first thing to snap in a tight economy. Are they hedging this exposure somewhere else on the balance sheet?
Oh, they heavily hedge it through their second engine, home improvement lending. This segment accounts for 32% of their loans, and the borrower profile is entirely different.
How so?
Well, the home improvement portfolio reached $885.6 million this quarter. Originations were up 31.7% to $128.6 million. The yields are naturally lower here, sitting at 9.69%.
Because the credit profile is better.
Way better. Pristine, actually. The average FICO score for these borrowers is an excellent 768.
Wow. A 768 FICO homeowner putting in a new roof or replacing their HVAC is essentially the safest consumer credit profile you can find outside of a conforming mortgage.
Precisely. These are structural, value-add investments to a primary residence, often driven by necessity rather than, discretionary luxury. So you have this barbell strategy.
Right. On one side, high-yield collateralized recreation loans driving massive top-line interest income.
Yep. And on the other side, lower yield, ultra-prime home improvement loans acting as a stabilizing anchor for the overall credit quality.
Which brings us to the third category. And mechanically, this is probably the most fascinating part of their business model right now, their fintech strategic partnerships.
Yeah, originations here jumped to 247.1 million, up from 168.6 million a year ago.
But we aren't talking about Medallion holding these loans on their books to collect interest over 5 years, right?
No, not at all. This is a pure velocity play. Medallion acts as the bank sponsor. They provide the regulatory framework and the balance sheet to originate point-of-sale loans for various fintech platforms.
Got it.
But they hold these loans for an average of just 5 days before selling them off to institutional buyers.
So they're essentially acting as a momentary warehouse line. A consumer clicks buy now, pay later on an app. Medallion's balance sheet briefly funds it to satisfy banking regulations, and within a week, that loan is bundled and sold off.
Sold to a hedge fund or a pension fund, exactly. The beauty of that mechanism is that it generates purely fee income without adding any long-term duration risk or credit risk to Medallion's balance sheet.
Oh, wow.
Yeah, this quarter alone, that 5-day turnaround model generated $1.1 million in fee income. It's a highly efficient, capital-light growth engine that perfectly complements their traditional portfolio lending.
Okay, so let me get this straight. We have a company operating with a barbell credit strategy, running a highly efficient fintech velocity model on the side, and growing originations by 63%.
Yep.
This brings us to the exact mechanism that triggered the stock's Day 2 slide. If the operational execution is this strong, why did GAAP net income just fall off a cliff?
It's a great question.
Because net interest income grew 7% to a record $57.2 million, yet total GAAP net income attributable to stockholders fell to $7.4 million, down sharply from $11.1 million a year ago.
The culprit is a relatively new accounting standard called CECL, Current Expected Credit Loss. If you want to understand specialty finance today, you have to understand the mechanical reality of this rule.
Right, CECL.
Under the old incurred loss model, lenders provisioned for bad loans as defaults became probable. It smoothed out expenses over the life of the loan. CECL completely inverted that logic.
How so?
Today, lenders are required to front-load the lifetime expected credit losses on the exact day a loan is originated.
Wait, so CECL is essentially like signing a 5-year lease on an apartment and the landlord forcing you to pay for every potential scuff mark on the walls and every hypothetical carpet stain on day 1.
That is exactly what it's like. It drains your cash up front, even if you turn out to be a perfect tenant for the next 5 years.
So because Medallion grew their core originations by 63% and put so many new loans on the books this quarter, CECL forced them to pre-fund a massive theoretical damage deposit.
Bingo. They took an upfront provision hit of $22.3 million. That charge flows directly against current earnings, even though those specific loans haven't missed a single payment yet.
Wow.
The math is brutal on GAAP net income. Management is effectively being penalized on paper for executing a highly successful growth quarter.
Wait, so they are a victim of their own success?
Pretty much.
If CE Key front-loads the pain of high-quality loan growth, shouldn't we view this $7.4 million net income dip as a bullish leading indicator for future quarters rather than a reason to sell? I mean, they are absorbing the accounting pain today to build a fortress balance sheet of interest-earning assets for tomorrow.
You would think so, but it's short-sighted algorithmic screeners just seeing a year-over-year earnings drop, though we also have to acknowledge the other headwinds in that print.
Right.
The year-over-year drop was exacerbated by a really tough comparison. Last year, in Q2, Medallion recorded a one-time pop of $6.1 million in equity investment gains. This quarter, that non-core revenue was just $0.2 million.
Okay, so combine the absence of that one-time gain with the massive CECL provision.
And layer on operating expenses that tripped up to $25 million, and you get that compressed bottom line.
And we haven't even touched the primary catalyst for the Day 2 sell-off margin compression.
Right.
Margins. The net interest margin, or INIM, on gross loans contracted from 8.9% down to 7.94%. NM on net loans fell from 8.42% to 8.28%.
You really have to think of their loan book like a time capsule. The temporal mismatch is the core issue for any lender right now.
Because of the Fed.
Exactly. Medallion has older loans sitting on their books that were originated years ago in a zero interest rate environment. Those yields are locked in. But today, the Federal Reserve is keeping rates elevated, meaning Medallion has to pay much higher interest rates right now to depositors and bondholders to fund their operations.
So the cost of their liabilities is repricing upward in real time, while the yield on their older assets is static. That squeeze between past yields and present costs is what compresses the margin.
Which the market hates, because it signals that a company is working harder just to maintain the same level of profitability.
Which forces the analytical focus back onto the actual quality of the assets they are holding. I mean, if margin compression is squeezing profitability and CECL is forcing them to reserve $22.3 million for future losses, the existential question is whether those future losses are actually materializing.
Are the borrowers defaulting?
Exactly. If you are looking at your portfolio right now, the CECL provision is just a theoretical model. The delinquency rate is reality. What does the reality look like?
The reality is holding up remarkably well. Delinquencies are ticking up, sure, which is a natural function of a seasoning loan portfolio in a higher rate environment, but they remain highly contained.
Give me the numbers.
For recreation loans, that 686 FICO segment we discussed earlier, the 90-plus days past due rate sits at just 0.57%, up marginally from 0.49% a year ago.
Half of 1% of the recreation portfolio is seriously delinquent. That is exceptionally low, given all the macroeconomic anxiety surrounding the consumer.
It really speaks to their underwriting discipline. And on the home improvement side, the 90-plus day delinquency rate is virtually non-existent at 0.17%.
So low.
Yeah. Now, connect those actual default rates back to the CECL reserves. Medallion has built an allowance for credit losses of 5.16% for recreation loans and 2.42% for home improvement.
They have built a fortress. Their cash reserves for future losses are sitting at 5.16%, while actual severe defaults are only at 0.57%.
Exactly. They have over-reserved by a massive multiple.
The balance sheet is effectively insulated against a severe macroeconomic shock, which is exactly what you want to see if they are going to push origination growth by 63%.
So you have a heavily provisioned balance sheet, strong credit performance, and record asset growth. But this brings us to a historical anomaly that we have to address.
The ghost of the New York City taxi medallion.
Because it still heavily dictates how the market prices this specific equity.
We really have to look at the historical context here so you can truly understand why this company's current pivot is so remarkable. A decade ago, a single New York City taxi medallion was an appreciating asset worth over $1 million.
And Medallion Financial built their entire corporate identity financing those assets. It was an incredibly lucrative, seemingly impenetrable moat.
Until Uber and Lyft fundamentally destroyed the artificial scarcity of the taxi market. The value of those medallions collapsed. It bankrupted countless drivers and severely impaired the lenders who financed them.
Medallion Financial took massive write-downs. They spent years restructuring their business to survive a disruption that killed many of their peers.
And a lot of retail and institutional investors still associate the ticker MFIN with that legacy trauma. The name itself is a psychological overhang.
But the numbers in this Q2 print prove that the legacy business is functionally dead. It's entirely de-risked. Net taxi medallion assets are down another 42% year over year. They currently sit at just $3.5 million.
Out of a $3.194 billion asset base. Taxi medallions now represent a microscopic 0.1% of their total assets.
Right. They actually collected $1.8 million in cash on those legacy assets this quarter, resulting in a net recovery of $1.4 million. It is no longer a systemic risk. It is a rounding error that occasionally generates a slight cash recovery.
The company has completely rebuilt its DNA around consumer recreation, home improvement, and fintech partnerships.
Completely.
Which brings us to the ultimate question of capital allocation. We have a company with record assets, massive origination growth, highly insulated credit quality, and a deeply misunderstood accounting drag. How is management deploying their capital while waiting for the market to wake up?
They are executing one of the most aggressive, value-accretive strategies available to them, buying back their own stock.
I love this.
During this quarter, management repurchased roughly 780,000 shares at an average price of $9.85, spending $7.7 million. And they still have $6.7 million remaining on their current repurchase authorization.
Plus, they paid out their regular 14-cent quarterly dividend.
Mm.
But we need to pause on that $9.85 purchase price. Medallion's reported book value per share rose this quarter to $17.62.
Right.
Buying back your own shares at roughly $10 when the mathematical book value of the company is over $17 is like buying a dollar for 56 cents. It's a no-brainer.
It is a massive signal to the market. Management is essentially giving a middle finger to the algorithms that sold off the stock based on the GAAP net income drop.
Yes.
They are demonstrating that their underlying cash flow is so strong that they can fund 63% origination growth, front-load all the required CECL loss reserves, pay a nearly 5% annualized dividend yield, and still have the liquidity to retire their own equity at a massive discount.
And by retiring those shares at a steep discount, they're instantly accreting value to every remaining shareholder. Doesn't this aggressive buyback suggest management believes their own discounted equity is a better risk-adjusted investment right now than expanding the loan book even further?
Oh, absolutely. They are weaponizing the market's misunderstanding of their accounting metrics. It all comes back to that central tension of the earnings print.
Which is?
It is a battle between massive long-term origination growth and near-term accounting and margin pressures. On one side of the ledger, you have a company firing on all cylinders. They're originating high-quality collateralized loans, expanding a capital-light fintech velocity model, and completely severing its ties to a catastrophic legacy business.
And on the other side, you have the mechanical reality of CECL draining GAAP earnings today to protect tomorrow, plus a lack of one-time equity gains to pad the optics, and the unavoidable reality of margin compression as they navigate a higher-for-longer interest rate environment.
The time capsule of their loan book is slowly repricing, but the margin squeeze is real in the interim.
It requires an investor who is willing to look past the headline EPS and revenue miss to understand the structural plumbing of the balance sheet.
Definitely. The credit quality is pristine relative to the reserves. The growth is there. The valuation disconnect is staggering.
It really is a complex print that demands deep analysis, which leaves you with a forward-looking valuation question to ponder as you review your own holdings.
Oh.
Medallion Financial has successfully shed its legacy taxi medallion baggage, surviving an industry-destroying disruption to transform into a fintech-enabled consumer lending powerhouse.
Yep.
Yet despite the massive growth and the pristine credit metrics, it still trades at a traditional specialty finance price-to-earnings ratio of around 7.5.
Which is incredibly low.
Will the broader market ever look past the legacy name and the CECL accounting noise to re-rate this company with a premium fintech multiple? Or is the current macroeconomic environment of persistent margin compression going to keep a permanent ceiling on the stock price, forcing management to just quietly buy back shares at a discount forever? Something for you to mull over.
Yes.
If you want to keep tracking the hidden mechanics behind these numbers and figure out how the market digests complex prints like this, make sure to follow the show for daily, no-slough earnings coverage.